50.2, that's the current gold to silver ratio, meaning it takes 50.2 ounces of silver to equal the value of 1 ounce of gold. But here's what should terrify every precious metals investor. The geological ratio, the probability of these metals actually existing in the Earth's crust, is 17.5. For 5,000 years of human history, the price ratio averaged 15 to 1. Right now, we're at 50.2. That's a gap of 35 ounces. And when that gap closes, not if, when silver doesn't go up, it detonates. Let me show you the math that points to $333 per ounce. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on publicly available geological data and market history that anyone can verify. But by the end of this video, you will understand exactly why the widest ratio in modern history is creating the most compressed spring in commodity markets, and what happens when it releases. The United States Geological Survey estimates silver is 17.5 times more abundant than gold in the Earth's crust. Not 50 times, 17.5. Yet the price ratio today is 50.2 to 1. Think about that. Silver is currently priced at less than half its geological scarcity relative to gold. Why? 50 years of industrial consumption, treating it as just another metal while gold sat in vaults as monetary reserve. But geology doesn't lie, and mean reversion is inevitable. Let me show you what happens when this ratio corrects. Because history has shown us this pattern before. 1980, gold hit $850 per ounce. Silver hit 49.45. The ratio? 17 to 1. Almost perfectly aligned with geological abundance. Then came the crash. Silver fell harder than gold. By 1990, gold was at $380, silver at $4. The ratio? 95 to 1, the widest in modern history. What happened next? Correction. A violent correction. By 2011, gold reached $2,100, silver hit $48. Ratio? 43 to 1. The gap had closed from 95 to 43. Every single time the ratio gets extreme, it snaps back. Always, without exception. And we're at 50.2 right now. But here's where it gets really interesting. Let me show you the current setup. Gold, $4,641 and climbing. Citigroup projects $5,000 by mid-2026. Bank of America modeling $5,000 to $5,200. HSBC calling for $5,000 in first half of 2026. These aren't fringe predictions. These are major financial institutions, emergency revising forecasts. Now let's do the math. If gold hits $5,000 and the ratio corrects to just 30 to 1, not 15, just 30, that's $167 silver. At the historical average of 15 to 1, silver at $333. Not a moonshot prediction, just mathematics, just mean reversion to a 5,000-year average. But here's what makes this time fundamentally different from every previous ratio correction. Every past correction happened with ample silver supply available. 1980, above ground stocks were massive. The Hunt brothers accumulated 200 million ounces because supply existed. 2011, recycling was robust. Industrial demand could be met. The squeeze was purely investment driven. 2026, 3 consecutive years of structural deficit, more consumed than mined every single year. COMEX registered inventory draining from 80 million ounces in October 2024 to 113 million now, and dropping. China imposed export controls in December 2025. Strategic resource restriction, solar demand exploding. 200 million ounces annually by 2026, up from 85 million in 2020. The ratio correction is happening as physical supply disappears. That combination has never occurred before in modern history. Let me show you why this creates exponential pressure. In a normal ratio correction, investors shift from gold to silver for the arbitrage. Gold rises, silver rises faster, ratio narrows. But this time, industrial users are already competing for supply that doesn't exist. Add investment demand from ratio arbitrage on top of industrial panic. The price doesn't rise linearly, it gaps. Think about the mechanics. Silver at $92 with gold at $4,641. Ratio, 50.5. An investor holds 100 ounces of gold worth $464,100. They see the ratio at 50.5 versus historical 15. They calculate, if I sell my gold and buy silver when the ratio corrects to 15, I triple my wealth. So they sell 100 ounces of gold, buy 5,050 ounces of silver at $92. Now multiply that decision by institutional investors, hedge funds, family offices, sovereign wealth funds, all doing the same calculation, all seeing the same 15 to 1 target, all selling gold to buy silver. But here's the trap. There isn't enough silver to absorb that flow. Annual mine production, 880 million ounces. Industrial consumption, approximately 1 billion ounces. The deficit is already 148 million ounces. Now add billions in ratio arbitrage capital. Where does the silver come from? It doesn't. The price just rises until demand destruction occurs, except industrial demand can't be destroyed. Solar panels need silver, EVs need silver, 5G needs silver. So the entire adjustment happens through price. And the adjustment needed is 35 ounces per gold ounce across the entire gold market cap. Gold market cap, roughly $15 trillion. To correct the ratio by 35 ounces per gold ounce, that's trillions in capital that needs to flow into silver, against a silver market cap of less than 2 trillion and falling supply. Now let me show you the other side of this equation, the paper silver trap. SLV, the largest silver ETF, claims to hold 440 million ounces. Millions of investors think they own silver through SLV. Read the prospectus. Page 17. They can settle in cash if physical silver isn't available for redemption. Translation, SLV is a promise, not ownership. A promise that can be broken with cash settlement. When the ratio correction accelerates, when investors rush to convert paper to physical, SLV's fine print activates. Cash settlement at whatever price they determine is fair. Not delivery, not physical. Cash. And the real silver? Already consumed by industry, already locked in JP Morgan vaults, already exported before China's ban. The paper market has trained investors to think they own silver, they own exposure, they own a derivative, they don't own metal. When the ratio corrects, that distinction becomes catastrophic. Let me show you another pressure point nobody's discussing. Central banks, they're buying gold at record pace, 1,037 tons in 2023, the fastest accumulation since 1967. They're not buying silver. Why? Because in the current monetary system, gold is money. Silver is industrial. But when the ratio corrects, when silver reclaims its historical monetary role, central banks face a problem. Their reserves are unbalanced, heavy in gold, zero in silver. If silver revalues to $333, if the ratio hits 15 to 1, their reserve compositions are wrong. So what do? They buy silver to rebalance. Except there isn't enough silver in existence to satisfy even one major central bank accumulation program. China holds roughly 2,000 tons of gold reserves. If they wanted equivalent silver reserves at 15 to 1 ratio, that's 30,000 tons of silver. Annual global production, roughly 27,000 tons. One country rebalancing requires more than a full year of global output. Now imagine multiple central banks simultaneously realizing they need silver reserves. The buying pressure would be unprecedented. Here's what I think people are missing about this setup. The ratio isn't just wide, it's wide during a supply crisis, during industrial demand explosion, during geopolitical resource nationalism, during paper market stress. Every single pressure point is aligned in the same direction, toward ratio correction, toward silver revaluation, and the math is undeniable. Gold at 5,000, ratio at 15, silver at 333. Not because I predict it, because that's what mean reversion means, return to average. And the 5,000-year average is 15 to 1. Let me address what you're thinking. Could the ratio stay wide? Could silver stay suppressed? History says no. The ratio has never stayed above 50 for extended periods. It always corrects, sometimes slowly over years, sometimes violently in months. 1979 to 1980, ratio went from 40 to 17 in 12 months. Silver 400% gain while gold doubled. 2008 to 2011, ratio went from 80 to 32. Silver 300%, while gold 160%. The pattern is clear. When the ratio is extreme, the snapback is violent, and silver moves multiples faster than gold. We're at 50.2. That's as extreme as it gets outside of crisis moments like 1990. But here's the crucial difference. In 1990, there was no supply deficit, no industrial demand explosion, no China export ban, no COMEX drain. The ratio was wide, but supply was abundant, so the correction took years. This time, wide ratio plus supply crisis. The correction won't be slow. It can't be slow. Industrial users can't wait years. They need metal now. So here's what this actually means. The gold-silver ratio isn't just a trading metric. It represents a 50-year mispricing. Silver classified as industrial commodity, while gold remained monetary. But silver is both. Always has been. For 5,000 years. When currency crises accelerate, when fiat loses credibility, when central banks print trillions, silver reclaims its monetary role. That reclassification is worth hundreds of dollars per ounce, and it's happening right now. In 2011, during the last major silver surge, a refiner was interviewed on financial television. The reporter asked, "When does silver stop being industrial and start being money?" His answer, "When people stop trusting the paper." The camera cut away quickly. But that's the truth. Silver becomes money when fiat fails, and every currency crisis in history has driven the ratio toward 15 to 1. Now here's the part that should terrify gold holders. Gold's rise to 4,641 is driven by Fed independence crisis, geopolitical chaos, central bank buying. Silver is following, but slower. The ratio is actually widening even as both metals rise, from 48 in early 2025 to 50.2 now. Gold outperforming silver, that's creating a coiled spring, maximum tension. When the ratio snaps, silver won't just catch up to gold's gains, it will magnify them. Gold up 50% from 3,000 to 4,500. Silver up 150% to match the ratio correction. That's how mean reversion works. The laggard doesn't move incrementally, it moves explosively to close the gap. Here's exactly what I'm watching. When the ratio drops below 45 to 1, the correction has started. Below 40, acceleration phase. Institutional money is flowing. Below 30, panic buying. Central banks entering. Industrial users stockpiling. At 15, equilibrium reached. Historical average restored. We're at 50.2. That's 35 ounces of spring tension waiting to release. And with supply deficits, paper market fraud, industrial demand, and potential central bank late entry, the snap could be the most violent in modern history. $333 per ounce isn't a prediction. It's gold at 5,000 with the ratio at 15 to 1, the geological average, the historical norm, the mathematical mean. And you just watched the widest ratio in modern history begin its inevitable correction toward a 5,000-year average. Mean reversion isn't a theory, it's gravity, and silver is about to fall upward. This might be the most important ratio setup in precious metals history, and it's happening right now.